Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little bit of money here. My job is not just to entertain, but put everything in context, including tonight's trading. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Hype cannot destroy the hope of artificial intelligence, even though many investors have begun to turn on the entire concept of machines that you can talk to or even replace your workforce with. But perhaps hype has taken stocks involved with artificial intelligence too high versus reality. Have expectations at last gotten too high to be equaled, let alone beaten? Well, you know what? That is tonight's quandary as I survey the battlefield. The negative drumbeat, kind of lurking like white noise in the background, wafted center stage this afternoon as NVIDIA, the king of AI, reported earnings the market didn't like. While the averages matter, with the Dow gaining 147 points, S&P advancing 0.24%, NASDAQ edging up 0.21%, the looming NVIDIA quarter dominated the market's mindshare in a very negative way. So when NVIDIA actually reported after the close, it was kind of an anticlimax. The company reported a healthy top and bottom line beat with robust guidance for the current quarter. That's excluding any new Chinese business now that they can sell decent chips there. But NVIDIA's all-important data center sales came in a tiny bit light, surprising, and frankly, fitting the negative rap that we've been hearing. So the stock got dinged in after hours trading. I think that's mostly because it was up 35% for the year going into the quarter, and expectations were indeed sky high. But that's the charitable explanation. The damning one, things are slowing, and perhaps the $4.4 trillion emperor has, fewer clothes than we thought. All in all, though, in reality, it's a good quarter. It just wasn't decisive enough to settle the biggest conundrum of AI, which is a sense that perhaps companies aren't getting the return, the bang for the buck that they should when they're buying NVIDIA stuff. Mind you, I am not talking about China. That also remains a quandary for the company. I am talking about the giant spend that has boosted NVIDIA's market capitalization to the biggest in the land, $4.4 trillion, and maybe that so-called peak. So tonight I want to explain why, even after this poorly received NVIDIA quarter, I think AI is worth every penny. Even as many seem to believe that it's nothing more than a parlor game brought to you by some high-tech hucksters who've buffaloed the entire world. First, in the wake of these NVIDIA numbers, let me just give you the negative briefs. You know what I'm talking about? Which is often expressed by younger people as reminiscent of the dotcom bubble. Something that occurred, by the way, while they were in their Dr. Dentons, or maybe their Huggies, if not their respective mothers' wombs, or even the proverbial twinkle in the eye. In the late 90s, we discovered that we could plug our computers into phone lines. They would make this really funny noise and then bring you something called a website. Some people really got it. As someone who could actually arguably be described as an internet pioneer, I actually suggested to the Wall Street Journal that they could post the whole thing online. They laughed me out of the room. So I decided to do it myself. It was called thestreet.com. No one really knew what the heck they were doing back then. People were just throwing nearly as much money, at least in $1990, as they're throwing in now, okay? I got money from a bunch of venture capitalists. We worked for a couple of years, put about $75 million to work, and voila, the stock opened at an insane $1 billion valuation. Now, that was a bubble, especially because we went to $2 not that long after. 330 companies went through the same process as we did at the street. At least we stayed alive. Those didn't. Most of them ultimately went under. Very few came through the other side, like Amazon. But people remember the losses. The worst losses came from the fiber optic companies that laid the track that powered the internet. Okay, get that. Because that's the latter-day NVIDIA. The second worst came from the search engines. The third came from the phone companies. A huge number went bust. What didn't go bust? Okay, Amazon, Cisco, Google, fortunately hadn't come public yet, so it didn't get to go bust. They joined the previous winners of the PC revolution, Intel, Microsoft, and Apple. The others never saw the field. The losses were staggering. But those winners, they were amazing. They were run by the smartest people who took advantage of everything you could ever take advantage of, and they made their shareholders fortunes. As they grew, we heard at every turn that they were just parts of the bubble, and then when the bubble burst, it would just be a matter of time before they would burst too. A matter of time, a matter of time, a matter of time. Well, the time mattered. Nothing happened. Sure, Intel and Cisco didn't soar like the others. Cisco's still very much alive. A mismanaged Intel needed President Trump to get the money to be able to stay a survivor. Right now, I'm hearing that what we call the hyperscalers, the companies spending on fortunes on NVIDIA, the ones who are writing the checks to NVIDIA, are part of the AI bubble that was just like 2000, okay? Microsoft's like 2000, Amazon's like 2000, Google's like Oracle, which missed the internet, well, but is all in a data center, Meta, and even Tesla, which wasn't around to birth the internet. They are all writing these checks, and it's wrong that they do so, and that's what tonight's quarter showed. I don't know. Did they all go wrong buying accelerated computing and generative AI chips? It's the equivalent of all the companies that participated in the making of the building blocks of the internet. Tonight, people are wondering whether the money being spent on NVIDIA is finally peaking and petering out. Now, I want to stipulate some things. First, the companies I just mentioned, the hyperscalers, are run by the smartest people on earth. Second, they have the better balance sheets than any country in the world. They have incredible revenue growth. Apple is the only one of these heavy hitters that isn't writing huge checks to NVIDIA simply because they don't have an AI strategy. Apple stock, by the way, is the poorest performer of the big tech stocks. Will that change after tonight's numbers? Well, Apple turned out to have the last laugh while all the others fall flat on their faces. Is NVIDIA fooling everyone? Is Jensen Huang fooling everyone? Are the valuations all way too big there? Listen. We heard the same thing about the dotcom survivors at the turn of the millennium. We, who liked those stocks, were called clowns. I was considered, yes, a genuine, legendary Wall Street funny man for supporting them. And then I came up with this ridiculous thing called FANG, and people really laughed me out of the building. Thank you, Bob Lang, for helping me on that one. He's for the stream. You know what's ironic? I often hear from people far younger than I am that we've heard this before, and all these companies are delusional, and so are their CEOs and the buyers of the stocks. These young skeptics tell me that we're looking at the biggest bubble in history, with NVIDIA, the backbone of generative AI, being as overvalued as Cisco was in 2000 when it was worth $550 billion. It's true, Cisco was overvalued at the time. It's now worth a little less than half of that. But here's what I have to say to them. I don't care about the seemingly sky-high market capitalization that these stocks have. I'm simply trying to put a valuation on a company that makes what you need to become one of the serious players in AI. I learned not to question Amazon or Microsoft or Google or Meta or even Tesla, the big customers, a long time ago. They know more than I do. They are run by people much smarter than I am. Much, much smarter. I'm just grateful they let me along for the ride. So feel free to dismiss AI as a bubble. But the bottom line, during the 3 or 4 years of the dot-com bubble, people did make fortunes who had faith. And some, yes, you had to ring the register for. But even when the dot-com bubble burst, there were a handful of fairly obvious winners that eventually came roaring back. You did have to be courageous to buy them. If you gave up on Amazon in 2001, you missed the $2 trillion boat. If you give up on NVIDIA now, I think you could miss a boat that's not sinking, just resting, before it reasserts itself. So I say, own it. Don't trade it. Let's speak to Ian in Florida, please. Ian.
Booyah, Jim. How you doing?
I am doing well, Ian. How about you?
I'm doing excellent, Jim. Thank you.
All right, fill me in. What do you got?
Man, you know, I'm a 5-time caller and Investing Club member.
Thank you.
Absolutely.
I take it from Jeff Marks, too. Jeff right now is working on, he's doing a little work on the CrowdStrike there with the George Kurtz. How can I help you?
Well, Jim, I want to get your opinion on something. I've been looking at a stock. It's almost 50% down for the year from the 52-week high. NVIDIA has a pretty big stake in it, too. They're highly affiliated with NVIDIA. What do you think about getting into, at this point, CoreWeave?
Okay, look, I like CoreWeave. The problem is, I like InTrader Elias, the CEO. Here's the problem with it. People kind of are saying, you know what? It's moved up so much. It's going down. Here's what you do with a stock like CoreWeave. I learned a long time ago, sometimes stocks tell you what to do. This one is going to tell you what to do when it stops going down. And that has not happened. And do not count today, because today was a bounce back day. Let's see. This stock is going to tell us. I need to say that because it's losing money. When you have a stock of a company that's losing money, you have to let the stock tell you. And I can read. What can I say? I'm a stock whisperer. That stock is not yet done coming down. But I like your concept. I just think there are other better stocks in this market. Sure, there are a lot of losers in the dot-com bubble. I know 330 of them. But if you think we're in an AI bubble now, I think you got to go back in the history books. You got to do some work. Don't listen to the people who were in their Dr. Dentons at the time. Maybe they were in Pampers. Oh, maybe money tonight. The fast casual stocks have fallen out of favor in Wall Street, so I'm checking in with one of my old favorites, CEO Chipotle, get a better sense of what the company has in their pipeline. Then CSX has caught the eye of the activists. Is it this or is it this? I don't know. Why don't we go straight to the source to figure it out? Get the company's response. You don't want to miss that. And then Snowflake. Hey, how about the star that I've been on this show? Can you believe it's David Cramer?
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
to talk Chipotle. Specifically, why can't Chipotle stock get some distance from the new low list, given how good it is? For the better part of 2 decades, this is one of the greatest growth stories out there. Tremendous stock, too. But for over a year now, the stock struggled. And that includes last month when the Mexican chain reported a disappointing quarter. Worse, they lowered their full-year same-store sales forecast, which is why the stock plunged 13% in response. Now, at this point, a lot of investors are worried that even though Chipotle sells high-quality food, I had a delicious burrito bought just today, it's just not offering consumers maybe what they want, the kind of bargains maybe that they need. I don't know. Maybe that's one of the reasons why the stock's now down 29% for the year, which we know is not acceptable. So is this a buying opportunity? I know the company's in there buying, or do we need to be worried about it? Let's take a close look with Scott Boatwright. He's the CEO of Chipotle Mexican Grill to find out. Mr. Boatwright, welcome back to Mad Money.
Hi, Jim. Good afternoon, and thanks for having us on today.
Of course. So, Scott, first I want to talk about something that you're doing I think is going to combat a lot of what people may perceive to be an issue, a terrific new whole new way to order for small group build your own Chipotle, which we came down to a meal basically that costs about $8.50 if you do take advantage of this.
That's right, Jim. It's something we're really excited about. This is something we've had in the hopper now for probably over 12 months, trying to figure out how do we bring it to life in the most meaningful way where we can deliver on the experience. And operationally, we have it in the right spot. And it's really addressing a consumer need around, build your own Chipotle for family meal occasions as well as meal prep. We're really excited about it. It's off to a great start. And you're right. I think it's an extraordinary value. And if you order between now and October 21st with the code TRYBYOC, you can get $10 off your first order.
Well, look, I think that's a terrific bargain. I think up against that, for instance, look, I had a fabulous bowl today. I'm in downtown New York, but all in total, including, yes, the delivery was $28. That's unacceptable. It's kind of like it breaks let's just say it's kind of like there's a social convention of how much you can charge. It kind of exceeded that. Now, we all know food's gotten incredibly expensive. We also know that we love Chipotle. How do we solve this problem of trying to get that price down?
Yeah, Jim, it's a great question. And I'll start with, the average Chipotle burrito across America today in restaurant is still under $10. And I think it's still an extraordinary value. And I think about value, you've heard me talk about this in the past, as benefit over price. And what I want to do is continue to hold price constant and lean into the benefit of the offering. And I know there's more we can do around the occasion and make sure we're delivering or exceeding guest expectations both in restaurant and in digital to ensure we're delivering on the core equities of the brand, which are centered around high-quality ingredients, crafted with classic culinary techniques, prepared in restaurant in abundance with the value and speed you can't get anywhere else.
Well, okay, so let's talk about the difference between what we just described and what you and I know is just great food like I had for lunch and what the stock's doing. I mean, it is down 17% since you came in versus 19% up for the S&P. The restaurant group itself is up 8%. You're, again, down 17. I don't need to repeat how you are, but I do know maybe either you came in with the stock at a spike, it was at $60, or it's just that, like, right now at this very moment, the market says we want to be in pure value, something that you actually questioned on your conference call when asked by Mr. Tarantino of Baird. Maybe that's kind of the zeitgeist? What do we do here?
Yeah, I think the investment community at large, Jim, is trying to understand, are we a growth company or are we a mature company? I will tell you, I still believe us as the best growth story in the industry, full stop. We're navigating a really challenging consumer environment. The industry has been in negative transactions now for a couple of years. In the last recession, global recession, we were the last to go in and the first to come out, Jim. Right. I think we enjoyed a really strong year last year. And if you look at our 2-year comp numbers, they're still outpacing the industry and the segment of fast casual. So we feel like we're navigating an uncertain environment, and we need to do better to meet the consumer where they are. Yeah. And so I talk about this consumer flywheel, the three-legged stool around operations, digital, and marketing. And there are things that we are doing in our strategic plan to address the concerns that I still have in those 3 areas to ensure we're exceeding the consumer's expectations in this crazy environment.
So once again, I do want to be sure you think that it's possibility you can return to some higher same-store sales numbers, and it's not that we are right now in a situation where, let's say, Chipotle's great growth period is behind it.
No, Jim, not even close. I have a lot of confidence in our strategic plan. I have a lot of confidence in our leadership team. we'll get back on our front foot here. We've got a few levers we're going to pull. I can get to some of the things that we have in the innovation hopper here in a moment. But I have confidence we can get back to mid-single-digit growth. We're going to continue to grow restaurants at 8 to 10% annually. We will build another 315 to 345 new Chipotle restaurants this year. So we're excited about the growth ahead. We know we're navigating a cyclical environment that will change and turn as I think things become more steady in the macro and in relationship to whether what's happening with immigration, tariffs, and or taxes. I think once the consumer has more confidence to come back into the marketplace, spending will resume. And I think you know that the consumer today is still in a really good place. If you think about wages are still outpacing CPI, job markets are seemingly holding seemingly well. And so where consumers are cutting back based on the information we have is on restaurants specifically, and then leisure and hospitality. So we know the consumer is going to come back into the space. We have to ensure that we're delivering on value, as I described it earlier to you, Jim. And I think the brand will be back on its front.
All right, well, we just got to go over because I got to be sure because I like the company very much. I always have been a supporter. Darden during this period since you come in is up 47%. Papa John's up 10. Yum up 8. McDonald's up 18. These are all faced with the same situation that you are. Texas Roadhouse is up. Cheesecake is up 70. They're all faced with the same environment you are. So what we have to figure out is, are you doing something that must be changed? Because these other guys are doing, their stock is doing better than Chipotle. Doesn't mean that they're better than Chipotle, but their stock is doing better than Chipotle.
I understand, Jim, and I understand your exact point. I think what we have to do is continue to lean into the consumer experience, Jim, in a more meaningful way, and then really talk about our value proposition through our media channels in a more robust way. So I think our media program or our media strategy has to evolve a bit to ensure that the consumer understands the value proposition at Chipotle more fully. I think we need to do better in restaurant to deliver on that value proposition, both in restaurant and in digital, to ensure that the customer feels the value or sees the value when they get their order at home or in restaurant. So I know there's more that we can do today, Jim, but I'm confident we're navigating just a challenging environment. And then we'll come back out of this on our front foot in no time.
Is that why the company bought back $430 million worth of stock, although admittedly at a $50 basis? You're in there buying.
We are. We're buying more aggressively this year than we have in past years, Jim, because we have confidence again in the strategy. We have confidence in the plan. We know we have an extraordinary product that has high demand for the product. We just have to deliver on the experience.
Well, look, I've got to tell you, I'm glad that you came forward. I'm very excited about this, the whole new way to order for small group. And look, what can I tell you? We love the food as much as ever. So the stock is what I'm going to call a quandary. And I think that you are addressing the quandary, and that is what the shareholders want. Scott Wiltwright is the CEO of Chipotle Mexican Grill. Scott, it's so great that you came on.
Jim, I thank you very much for the opportunity to share our story. Look forward to seeing you in future earnings calls where we talk about better results for our organization. And the
all right,
industry.
Sounds good to me. Thank you so much, and Mad Money's back after the break.
Coming up, Cramer's hitting the rails and catching up with the CEO of CSX, seeing if it's full steam ahead for this rail transportation company. Next.
What the heck is happening at CSX, the big East Coast railroad that's under a ton of pressure from an activist firm, Ancora Holdings? Earlier this month, Ancora sent a scathing letter to the board of directors, only arguing that the company should merge with another large railroad as soon as possible or part with the CEO, who happens to be here tonight. Problem is, there just aren't that many freight railroads in this country. Neither Canadian Pacific nor BNSF seems interested in a deal, and the two other major railroads, Norfolk Southern and Union Pacific, they're already merging with each other. So let's hear the other side of the story from Joe Hendricks. He's the CEO of CSX to get his responses to these criticisms. Mr. Hendricks, welcome back to Mad Money.
Thanks for having me, Jim.
First, I'm talking, just so people know, the Railway Age is the most important publication in this industry, and you are the Railroad Man of the Year. So I want to ask the Railroad Man of the Year, who has been completely slagged and trashed by some fund that I don't know jack about. Well, how's the Railroad Man of the Year doing? And the fact that your stock is up more than everybody else other than the one that's in a takeover talk, does that mean anything? I mean, maybe I'm wrong.
Well, we are proud of our results, Jim. Let's start there. I mean, in the last 2 years, in 2023 and 2024, We had the highest margins in the industry for our rail business in 23. I mean, the second best in 24, but we had the best customer service in the industry, which led to some of the accolades that you talked about. And so we're proud of the operating results we have, we're proud of the team we have, and we're excited about the future. Because what we have right now is an opportunity we have never had before. Forget how we got here, but the railroads now want to work together to solve some of the problems that have been in here for decades to improve service and grow the business.
But don't they have to merge with each other in order to be able to make that happen?
That's been the theory that's been put out there. But in reality, the biggest problem that needs to be solved is in the interchanges around Chicago, St. Louis, Memphis, New Orleans, et cetera. It takes 18 to 24, perhaps even longer hours for us to interchange, and there's lots of cost and waste in that. Customers are saying, hey, we don't need this anymore. We want a seamless experience. You don't need to merge to do that. It's an option, and if somebody were to want to talk to us about that, we would have obviously considered that.
Of course, you think you're supposed to call these players, you're supposed to talk them into buying it? What is supposed to happen? You have a banker and says, listen, I may have been the best performer, but I give up?
Well, Jim, let's listen. We have the strongest railroad network in the East, the best margins, best customer service. We think the best employee engagement. So we like our position, and it has value. Obviously, Norfolk Southern, Union Pacific are pursuing one path. But we're in a situation now where we get to talk to all the other railroads. Right. They come to us, say, you're the only other railroad in the East. Not paired up with everybody, but first we talk with BNSF. Great opportunities there to work together.
Buffett, Berkshire.
Sure. Well, great opportunities to work together. We had made some announcements last Friday about growing our business.
You had who in the office?
Sorry?
You've been talking to Warren Buffett?
Well, I think he did announce this week that we did have a meeting in his office, but I'll let Berkshire Hathaway talk about
Well, what I care about is, did they make you an offer?
No.
Okay.
But they made it clear they want to work together to solve these problems and create growth opportunities for all of us, and that's the important point.
Would you be able to take share from trucks, which the U.S. public bears the burden of because they own roads, to be able to take the less pollution and run your own rails? Would you be able to make it so that you'd be more competitive?
Yes, because we get to work with the railroads like BNSF to solve these problems. We don't need to wait 2 years for regulatory approval process like the STB is going to go through with UPNS. We can do it now, and we can do it with Canadian railroads as well. We can start in the fourth quarter. We can show you examples how we can provide seamless service to go after that truck modal conversion now, not wait 2 years. And we don't have the risk of that regulatory process. And importantly, we get to do it as a partnership. And we learn and grow together. We're going to have all kinds of opportunities to talk about things that we're doing together with BNSF and others to create value. And we're the strongest railroad in the East, and people want to work with us.
Now, Joe, there are criticism that says that, I don't know how good it is that you're a cargo guy. You're not a railroad guy. You came from Ford. And the Incurred basically says like you came hat in hand. I actually remember you as someone who was kind of retired and done, and you got brought back in. But maybe I just read the articles and know the truth. Maybe that's
well, you do know the truth, Jim. But the facts of the matter is I was retired. 31 years in the auto industry is a long way. Retired as president of Ford. But we came back out of retirement to do this because it's worth doing. We said for the last 3 years, we need the railroads to work together to create value for shareholders and to create better service opportunities for our customers. We can't create value. The railroads have created all kinds of margin expansion over the last 8 years by cost reductions, getting a lot more efficient. Right. Investors now are saying, where's the growth?
Right.
Where's the opportunity?
Exactly right.
You have these great margins. How can you grow? And you haven't grown. We haven't grown because they haven't prioritized service. We have. We grew. We're the only railroad last year in 2024 that grew volume versus pre-pandemic 2019 with those margins that I talked to you about before. But now we have an opportunity to say, okay, let's solve these problems for the first time. You need two partners to do that, by the way, an East-West Railroad to do that. And we have that with BNSF. And we're going to create value now, quickly, and show you how we can do it together.
Okay, so one of the reasons why you got Railroad Man of the Year is that you took a fractious labor force and really somehow turned them into partners with you, and not just partners in name, actual partners, which you needed, by the way, because you had a horrendous hurricane that took down your network.
We did. We have 4 north-south routes. And we lost one of them due to Hurricane Helene. We're rebuilding it. Hundreds of millions of dollars are going to be back up early fourth quarter. We also took down the Howard Street Tunnel in Baltimore to be able to double stack containers for that and redo the tunnel because it's been 1890s it was built. Those two things are affecting our network, but we still had a 550 basis point improvement first quarter, second quarter with all that going on. All that's going to go away in the fourth quarter, and we're going to be free to run our network the way it is. But even so, we have some of the best operating metrics in the entire rail industry right now, even with those situations going on because of our people.
Now, there are a lot of people who'd be sitting right there and they would follow up by saying, and that's why we're not willing to talk to anybody and we're doing it on our own. What you have told me is, look, if someone comes in with a really good bid you're going to do what's right for shareholders.
Well, our board is, well advised. We're very active in all of this, and of course, we'll do what's right for shareholders. But we said on our earnings call, we'll open all possibilities to create value for shareholders, profitably grow the business, and serve our customers better. The and is important. We can do all of those by working with other railroads. There's a different constructs you can do that. And we're open to those constructs. But right now, the opportunity exists to work with 3 railroads to provide better service, especially with BNSF, across Transcontinental Railroad, across the U.S.
Okay, so talk to me about the business in general. I mean, there are a lot of people who feel like there's a bit of a slowdown in the country. I look at your numbers, actually, in the industry that you're in. I don't see a lot of slowdown. I think you're doing pretty well.
Well, our volume's up year over year for the for the first 6 months of the year, 7 months of the year even. But there are different stories to be told.
Okay,
the interest rate sensitive parts of the economy are still slower than you'd like them to be. Okay. Look at auto, look at housing, but also look at even chemicals. We've seen some softening in chemicals, but the aggregates like construction up, coal up. The grain harvest was strong. That ag business has been strong. So, and the intermodal business has been up and down because of the tariffs and because of ports and whatnot. But we need the industrial economy to get going. Since the pandemic, the industrial economy has not taken off. And if we can get that part of the economy going, man, we got a great opportunity in front of us.
If the Fed cut a couple times, would that help?
That would certainly help, for sure.
That would definitely help. And then the last thing I do want to do, and I don't want to leave on like a kind of a really kind of this note was nasty. Joe, I got to tell you, one point in my life, I know I'm on air, I was a nasty guy. I was not a diplomat. People didn't really think I was a gentleman. I never would ever write a letter like this. This is scathing. You don't deserve this. Okay, you don't deserve it because you're a good man. But I also bet that these guys would love to have you do talks with BNSF because then it's more likely that the Surface Transportation Board would improve the deal that they want.
Well, there are a lot of different motives going on right now.
Yes.
Our focus is on creating value for shareholders and serving customers better so we can profitably grow.
Well, you come with some sort of old-fashioned stuff to me?
Yes. Well, because that's all. It all creates value.
That's really all that it really is.
And
Joe.
It involves people and working together. And we have, I'm telling you, for decades, we have not had this opportunity. The railroads now want to work together to solve these problems. It's a great opportunity. We had a great investor day. We talked about great opportunity for 3 years. This is in addition to that. Wait until you see what we do over the next couple of years.
Well, look, I think that you've done a terrific job, but I thought it was really important that you had a chance to say yourself, Railroad Man of the Year, done a lot of great things for this railroad. I think you deserve better than what's happened from some of these guys, but I think the people in the industry know.
Well,
and by the way, so the stocks, because it was best stock other than Norfolk Southern, which was up on Takeover Chat.
Yeah, if you look at our TSR performance since I've been here, it was the best in the industry until the merger stuff started happening. Now it's still second best in the industry, even through today, and we got a lot to prove in the next couple of years.
Joe Hayes, you're a good man.
Coming up, fresh off its earnings report, Cramer's one-on-one with Snowflake, seeing if the AI boom can push this stock higher. Next.
After the close today, we got still one more blowout quarter from Snowflake, the cloud-based data management analytics platform that I like so much. Now, this comes on top of the last blowout quarter they reported 3 months ago. Tonight, they posted a solid top and bottom line beat, strong guidance for the current quarter, hence why the stock's screaming after hours trading. Not only does Snowflake have fantastic sales momentum, but the business is also becoming ever more profitable. It was the star of tonight's earnings parade. So let's take a deeper look with Sridhar Ramaswamy. He's the CEO of Snowflake. Learn more about the quarter, what he has the story here. Mr. Ramaswamy, welcome back to Mad Money.
Hi, Jim. Happy to be here.
All right, so Sridhar, congratulations, because not only did you post much better expected results, solid revenues, but this accelerating product revenue and these terrific operating margins, I didn't think this could happen so quickly. How is this coming together?
Jim, Snowflake is right at the center of today's enterprise AI revolution. We delivered a strong quarter, over $1 billion in product revenue, growing 32% year on year with a 5% beat. And AI is increasingly at the center of new customer acquisitions, and of our existing customers, 6,000 plus of them are using our AI products every week. This is why big logos, whether it's BlackRock or Thomson Reuters, are adopting our AI products. But what I'm very happy about is we are also innovating at a torrid pace while being operationally efficient, often by using AI ourselves. It's that combination that makes us feel very good. That's why we raised our guidance, and that's why we see an enormous opportunity ahead for us as a company.
Well, I'm so glad you mentioned BlackRock, because we adore Larry Franklin III. It's a huge position for my charitable trust. One of the reasons is because it's the most technologically savvy financial company in the world, largest depositor of assets in the world. How does BlackRock use Snowflake to make it so they continue to stay on top?
BlackRock has been a long-standing customer and partner. They have pushed us to become the amazing data platform that we are today. But specifically, they're using our AI products to create a customer 360 so that when you call in, the agent on the other side has access to every piece of information that they have about you. And that's all using Cortex, which is our AI platform. And they're setting an example for what you can get done with AI on Snowflake.
All right, so Sridhar, help me a little bit, because, there's becoming growing skepticism that maybe AI can't generate a return. But then when I look at what Snowflake's doing for their customers, I think the customers are generating a tremendous return. Can you explain this weird conundrum between people in our business who say, wait a second, it's really not generating a return, and the people who are employing Snowflake to make billions of dollars?
Well, that's the magic of the data platform that Snowflake is. We are consumption-based, which means that unless people are getting value from running things on Snowflake, we don't make any revenue and they don't spend any money. What we do at Snowflake is make AI super easy to use, but it's also enterprise grade. You don't have to worry about governance and who is going to see that data. It is that combination that makes it really easy for our customers to experiment, to play with, to get a feel for AI. We wanted to make sure that we could demystify AI for clients like BlackRock or Cambia Health Solutions, which has adopted Snowflake Intelligence, but they can do this one step at a time on their own terms and make sure that they can get value. This is similar to how we use AI, which is we roll out a small product like a little chatbot, it gets usage, then we build something big on it. We are busy rolling out Snowflake Intelligence to the entirety of our sales team. Just right now, I was looking at our relationship with a customer and learning so much more about it using our AI product. It's that ability to take customers on a journey, step by step, that I think distinguishes us. It's part of our overall ethos of making technology simple, making technology actually serve. That's why we've been so successful with AI.
Okay, so help me how the process works. Someone contacts you. You are a partner, for instance, with Azure, with Microsoft. Do you sit down with them and then you go to Azure and say, listen, our client wants to do this? Or do you go in with the client to Azure and say, look, I think you guys can help us on this?
Well, we work together with absolutely partners like the cloud service providers, AWS, Azure. But the more typical conversation is between one of our folks and an executive within a customer that wants to know how can Snowflake help with AI. And in fact, the standard offer that I make to every CIO, to every CEO that is a customer of Snowflake's is for them or their teams to spend one afternoon with a set of experts with Snowflake. I tell them we can create a dozen prototypes on top of your data that'll show you what's possible with AI. Let's demystify all of this and then figure out where we want to put meaningful amounts of time investments in. It's that process. It's the journey by which the ease of use of Snowflake, plus the fact that it's an amazing data platform, that's the thing that makes us shine in front of these customers because they understand how they can go step by step and create value with AI.
Okay, well, help me here, because there are a lot of people who feel, well, since AI cannot be relied upon, we got too ahead, we're over our skis. Turns out there's hallucinations. It may not really work for me. That's the opposite of what I'm hearing from you.
Well, AI is a technology. It has to be used responsibly. We pioneered, how RAG-based systems, the retrieval-based systems, could be used to create chatbots that would hallucinate far less. We sweated the details when it came to how can you make an AI model query structured data. We are the best in the world when it comes to that. If you build a solid foundation like that, if you build broad adoption, so tons of people are giving you feedback, then the value that you can get with the AI products on top dramatically goes up. It goes back to how do you make sure that a customer like BlackRock that is incredibly finicky about getting all the details right, trust what they're getting from Snowflake. It is our ability to walk them through that journey to also include things like observability when they create AI products, that makes us stand out. It is what delivers trust. It is what makes our customers feel convinced that we are the partners that they should be working with when it comes to AI.
Well, I think it's obvious that you can't just blunder into AI. You need someone like Sridhar and Snowflake to be able to make it work. Otherwise, maybe it is a waste of money. But I got to tell you, judging from your numbers, people are getting a terrific return on investment. That's Sridhar Ramaswamy, CEO of Snowflake. Once again, congratulations. This was a monster quarter, as was the last one. Great job. Good to see you.
Thank you, Jim. Great to see you.
Mad Money will be back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. I stand first to grab some fly. We play to the sound. And then the lightning round is over. Are you ready? Skeet that down the right. Let's go to Dave in Illinois. Dave!
Dr. Cramer, my man, a GNC Croatian traveler. How are you?
Man, I'm good. You must have put my pictures through Grok. What can I say, Dave? Good to have you on the show.
Jim, this $30 billion company provides connectivity for semiconductors in AI and in cloud computing. 12 of 15 analysts rate Arista Labs as a buy or strong buy. And its 3-year performance is off the charts. Jim, your thoughts on A-Lab?
Here's my thoughts. Dave, I feel like an idiot for not telling people to buy it. I look at it all the time. I turn to my colleague, buddy, pal, friend, Jeff Mark, and say, what was I thinking of Astera Labs? So I'm upset that I missed it. Let's go to Luke in Arizona. Luke.
Hey, Jim, thanks for taking my call. You know, I used to watch the show with my dad. Now my sons are watching it with me, so they're excited.
That's what I want.
Hi, Mr. Cramer. Hi, Mr.
Hey,
Cramer.
kids, how you doing? Kids got
Me and my
horse sense
family
there.
enjoy watching your show. Thanks for doing it.
Thank you, man. Nice kids you got.
Thank you.
Hey, thanks.
You're welcome.
That's Clark and Brady.
Hi, Mr. Cramer.
Well, all right, Mr. Cramer, the stock I'm calling about is Open Door Technologies. I'm wondering if the real estate market, the short interest rates...
You know, I've got to tell you, this is a meme stock. The person who left the company, the CEO, was a straight shooter, and I don't really understand what happened. But I'll tell you this: I am not going to jump on a situation that I thought was heavily, that some would say was manipulated. Okay, some would say. I'm not going to jump on that train. Let's go to Brian in New Jersey. Brian.
Hey, booyah, Jim. Four-time caller over your 20-plus years. Congrats for what you do. You're 3 for 3, batting 1,000 for me.
Well,
you don't just give a person a stock idea so that they can make money. You teach a person how to pick their stocks, and they'll make money for the rest of their lives.
Thank you. And that is actually that's what my book's about, which is that I can teach you so that even though I intend to be here 47 years from now, it could be, I don't know, the odds. It's going to be tough. The odds are tough, but don't count me out.
I'll still be with you.
All right,
I read your book.
Thank you.
All right, my question is RGTI, Rigetti Quantum Computing.
Okay, here's my view on quantum computing. It is for real. Is Rigetti my favorite? No, but Rigetti's one that could have a headline tomorrow. It's like Oklo/Oklo. I said when it was in the third, enough, I can't take it anymore. I think that this one's like that. Rigetti could have something that could be a home run. I don't want to keep you out of it, but it is a speculation. Please remember that. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, is this the market of M&A? Cramer is digging into the major uptick in company mergers and deals and what the trend says about the strength of the market. Next.
More buyers than sellers, kid. Right, that's a wise guy term, something is said to clueless newbies on the trading desk who can't figure out why a stock's going higher. But even though more buyers than sellers doesn't tell you very much, it's a reminder that the stock market, like any other market, is at the mercy of supply and demand. Right now, this market's staying buoyant, in part because there are far fewer shares floating around. So when a big account goes to buy a stock, they're more likely than not moving it. In other words, we've got the makings of a potential stock shortage. And where's it coming from? Takeovers. Today, Bloomberg News published a terrific piece headlined, Deal Makers Top $1 trillion in M&A with busiest August since 2021. Yep, we've had over $1 trillion in M&A activity since just the beginning of June. That's up 30% year over year, the biggest amount since the record-breaking summer of 2021. Remember, the Biden White House took a very forceful stance on antitrust enforcement. I've never seen an administration that was more anti-takeover in my lifetime. His FTC was a horror show for deal makers because they repeatedly sought to block even the most benign of deals. Of course, like I told you last night, Washington is not all that important to the market, so stocks rallied nicely under Biden as profits stayed strong. But for 4 years, the vast majority of potential takeovers were put on hold, and takeovers are the easiest way for stocks to go higher. Now, we've got a much more takeover-friendly administration. The deals are coming fast and furious. For example, I'm used to a very slow August with almost no deals. Do you know that this year we've had $300 billion in deals, including this Keurig Dr. Pepper purchase of JDE Peet's for about $18 billion, AT&T's attempt to buy the Spectrum licenses from EchoStar for $23 billion, and, of course, as you heard earlier, Union Pacific all aboard! Seeking to acquire Norfolk Southern in a huge $85 billion railroad deal. And yes, Palo Alto Networks, a charitable trust position, snapping up CyberArk for $25 billion in cash and stock to boost its identity-based cybersecurity exposure. Phew. Of course, there are plenty of other ways for the market to go higher. Profits can increase, the Fed can cut rates, new cash can come in. But at its most basic, we're talking about a stock market, a market of stocks. And if there's less stock, the remaining merchandise will most likely go higher. Plus, when there's more M&A activity, that generates a lot more fees for the banks. And when the banks go higher, they tend to take the rest of the market with them. Why? Because they provide fabulous leadership that gives us confidence. I think that this is just the beginning of a wave of mergers that can drag this whole market higher, as long as we don't get a similar wave of IPOs that flood the market with new supply. We still haven't seen many deals, and when we have them, I got to tell you, not a lot of shares are actually being offered. We've had very few mergers in pharma because the Biden FTC was so effective in trying to quash deals in that industry. As a result, there are now way too many drug companies. We need far fewer banks. Retailers should be merging like crazy. So should the industrials. And it is ridiculous how many tech companies there are out there, which is why Palo Alto's takeover of CyberArk made so much sense to me. Probably never could have happened under Lina Khan, the FTC nemesis of all business. I think mergers are essential to capitalism. They can rationalize industries and create new competitors that rival the heavyweights. But at the end of the day, what matters to me is that takeovers take out stock. And when you take out stock, you drive up the prices of all the other stocks simply because of a lack of supply. That, more than anything else, is why I like this market. Sure, we can get sidetracked. We can question whether we have an independent Fed. We can wonder about the distortion of tariffs. We may be perturbed by inflation. But I think the coming wave of takeovers could be more powerful than all of those in terms of the direction of the market. Regardless of how you feel about antitrust policy or the current president, the fact is the Trump administration's merger-friendly attitude is just simply great news for your portfolio. I'd like to say, as always, bull market summer. Prompts our friend just for you right here in Mad Money. I'm Jim Cramer. I'm going to see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.